Fine. So we were talking about reverse repo rates and repo rates. So repo rate is something which is charged by the RBI whenever it gives loans to the banks. And reverse repo rate is something which is given to the banks by RBI against the deposits. Okay. So as of today, as I was telling, 4% is the repo rate and 3.35% is the reverse repo rate. So why these four terms I told you is we will be using these in the coming days also. We should understand these terminologies because we are talking about banking system. Yes. Let us try to understand what are the reforms which have taken place in the last few years, which has helped the financial system of our country to strengthen itself. See, ultimately, if you don't allow the people to invest, the whole financial system is going to collapse. So when investment is needed, there is a need for certain freedom also. Okay, so that is why certain reforms were done in the Indian financial system to ensure that the people are safely investing in different areas, projects, companies, so that they can get good returns out of them. Let us try to understand these reforms. Basic six categories we have. That is new industrial policy, new trade policy, fiscal reforms, monetary, capital market, and dismantling price control. So we are more interested into first two of them. Okay, so we'll discuss the other also, but we'll discuss these things in more detail. So hope you all remember in 1991, industrial trade revolution happened. Okay, so during which new industrial policy and new trade policy were being established. So under these, what are the facilities given so that it promotes the industrial development of the country? So let us try to understand one by one. So under new industrial policy, the industries had been freed so that to a large extent, especially when it comes to licensing and controlling activities, by the government, they had been relaxed with. They were allowed and they were encouraged for modernization so that huge investors can come up and start up businesses, ultimately creating these employment opportunities as well as investment opportunities. So the abolition of licensing facilities and control facilities were relaxed after this new industrial policy of 1991 for various sectors. And by doing this, what happened? New bigger companies started investing into these businesses. Okay, so especially licensing restrictions are the one, like for example, if a foreign investor want to invest in India, he has a lot of difficulties in terms of getting a finance. So he has to tie up with Indian companies, and all those things were there earlier. But now today that freedom is given to them in certain sectors. Okay, there was a time when the whole country was actually against foreign direct investments in retail businesses. Okay, but later that bill was passed and everything went on well. But why it was being done? Because Indian retail sector was going to be affected, so people were opposing it. But of course we need competition, we need good big investors to enter into India, so that ultimately the standard of living can also be improved of the people. So the first major reform which happened was abolition of licensing. Then second was freedom to import technology. So a lot of latest technologies were developed in other countries, wherein you can import those new technologies to our country and ultimately give a better service to its customers. Okay, there were a lot of foreign technological collaborations which were allowed during this time, wherein the Indian companies tied up with the foreign companies for latest technologies. So using those latest technologies, one is quality output, errors are less, and fast production, increased production. So if it is handmade, obviously it will take a lot of time. If it is machine made, it will take lesser time. So like this, technology was, the freedom for importing technology was given to the companies. Then comes the third reform, that is nothing but contraction of public sector. Earlier were the days where certain public sector areas were not privatized, were not allowed for privatization also. But after this announcement of contraction of public sector, lot of public sector or government under business operations were open for the private investors. Like we have this electricity, HESCOM, BESCOM and all, right? So that was earlier public sector, but now it is being open for private sector, which are being maintained by the private sectors. Okay, so that is one more facility reform which happened after new trade, new industrial policy here. So privatization was encouraged here. Then the fourth one was free entry for foreign investments, right? Earlier, it was so that uh, not more than 45% of investment, 49% of investment was allowed in India, even whenever a foreign investor would want to come to India. Right, till today also some areas or some priority industries are there where government permission is needed today also. But some like hotel businesses, hospitals, export houses. So some areas have been relaxed with free entry. Okay, so there 100% investments can be done by foreign investors. So that is one more reform. Then comes your MRTP Act. MRTP stands for Monopolies and Restrictive Trade Practices Act. The restrictions by these were removed. The companies now do not need to seek the government permission to issue the shares, extend their area of operation and establish a new unit. According to MRTP Act, a lot of restrictions were put on these areas. Now those are removed. The company can launch its shares without any difficulties. Sorry, without any difficulties, without any restrictions also. Okay, so that is MRTP restrictions being removed. Then we have FERA. FERA is Foreign Exchange Regulation Act. Now it has been replaced with something called as FEMA. Earlier it was known as FERA. Now it is called as FEMA, that is Foreign Exchange Management Act. So this act actually regulates the foreign transactions. The transactions have become more simpler now. In world trade, in world forex market, for foreign exchange market, the transactions in terms of foreign exchange activities have been simplified very easily. There were a lot of restrictions if individual investors wanted to invest in foreign currencies. Now those restrictions have somewhere been relaxed. So that is one more reform which happened. Lot of importance was given to SME sector, small and medium enterprises, because the government has understood that small and medium sector businesses, they contribute to very highly for the GDP of the country. And if you give them some little bit support and facilities, they can really do good. So efforts are being made by the government to improve on the SME sector. So here importance is now given to the SME sector. So that is what one more reform which happened during industrial policy. Under new trade policy, yes, when it comes to export import trade activities, lot of restrictions were removed out. Okay, so yes, a few are there in terms of gold or in terms of fuel or certain businesses. The restrictions are still there, but especially vegetable, fruit business, flower businesses, lot of restrictions have been removed for the reason to promote import and export. Okay, so export your materials to other countries, import good technologies from other countries, so that you can improve on your production processes, right? Then comes your tax, in export import tax. It was also reduced so that export import activities were promoted. Okay, so the companies had were given a relaxation on these areas so that they can have export import businesses with other countries also. So by doing so, you are playing in the world market. Okay, so you are getting a recognition in the world market. So that was again a relaxation given. So earlier there was lot of restrictions in terms of export import business activities. So if you want to buy some technology from a foreign company, it used to take or eat lot of time and what I can say, a lot of time and money involvement, and certain restrictions were there from the government of the country, right? So these all things were relaxed now. The procedure is very simple. We have Exim Bank, we have ECGC, who are helping the companies to conduct export import businesses. Okay, so we will be discussing Exim Bank and ECGC in the coming classes in detail, what are their functions and all. ECGC and Exim Bank are certain institutions which are helping and promoting export import businesses for the country. If you are going for export, okay, that is if you want to start your businesses in other countries, or if you want to send your goods to other countries, the government can help you even by providing incentives. Why? Because it is very very important that export should be more when it comes to uh, import. Okay, so a good healthy economy is only when exports are more than imports of the country. Okay, so to promote that export activities, incentives are being provided by the government to small scale industries also, especially small and medium scale industries especially, and they are motivating them to involve themselves into export activities. uh, then we have market determined exchange rate regime here. Of course, the exchange rate regime, from a single currency fixed exchange rate system to fixing the value of rupee against the basket of currencies, and further to market determined floating exchange rate regime. Right? Earlier, the countries used to fix the exchange rates, but now it goes on currency value. Okay, value of rupee against value of US dollar, or Canadian dollar, or yen, right? So, so based on the value of that rupee, you will be the exchange rates are being fluctuating in the market, right? So earlier, there was a strong role of government and the banks especially, which used to determine the exchange rates, but today it is automatically happening, and it is dependent upon the demand and supply in the market. So that is why I always suggest, or always tell that, instead of keeping the money in banks, sorry, in houses, keep it in banks. Because if banks have more funds, then our Indian financial system will also strengthen. So this is one more reform which happened, wherein exchange rate, determining the exchange rate was done on demand and supply here. Then there were some fiscal reforms which you have already studied in first semester, so I'm not going too deep in it, into it. So this is the policy of a government which is connected with income and expenditure. Okay, so that is what your fiscal policy is. Then we have monetary reforms. It's a sort of a control policy through which the central bank controls the supply of money, okay, in the market. So as I told you, if more money is supplied into the market, the value of rupee will be lost. So they will control that supply of money into the market. So those things are controlled by the monetary policies here. Then we have this capital market reforms, especially for portfolio management. It can be the SEBI, that is Securities Board, sorry, Securities and Exchange Board of India, SEBI. It is the one which actually controls the whole capital markets. Okay, so that was brought into existence to control the capital markets. Then we have dismantling price control system. The government has taken a lot of steps to remove the price control in case of many products. And what does this price control mean? It mainly means that the companies will sell the goods at the service at the prices determined by the government, not whatever they want. Why? Because they don't want the companies to exploit the common man, right? So petrol, steel, fertilizers, iron, all these products are controlled. The price is being controlled by the government itself, so that the people are not being exploited by the companies, right? So these are some reforms which took place in our Indian financial system, and which has really facilitated to strengthen the Indian financial system of our country. Okay, so any doubts on this?